Thank you, Shobhit. Hello, everyone. Good morning. I hope everybody has joined in. Uh, Maybe I can wait for a minute or two so that once everybody joins in, then we can start. Okay. So I hope whoever was joining has joined in. So let's start with today's session. A very warm welcome again to all of you. So the topic for the day is India's 7 cash flow statements. And I hope you must have, prepared the cash flow statement by now for, various practical questions you must have practiced until now after your regular sessions were conducted. So today what will we do? We will quickly, revise the key concepts, what we have learned under India's 7 statement of cash flows. And then we will jump on to, preparing the cash flow statements practically, right? And we will see what all nitty-gritties we need to handle. And we need to be careful about, preparing the cash flow statement so that we don't do any mistakes while doing that. So that's the objective. Okay. So before we actually, start, can I ask one question? What is the need of preparing the cash flow statement? Why, we are preparing the cash flow statement? What's the objective? Anybody, please?
Sir, good morning, sir.
Good morning.
To provide the information about the changes in cash and cash equivalent during the
Mm-hmm.
particular period,
Mm-hmm.
and to check from where the whether the company is able to generate the cash and cash equivalent, and to understand the timing in which the cash will be generated.
Correct. Right. So basically, what the statement of cash flow, tells us, it tells us about one thing, how the cash is, being moved, right? So what are the cash flows that are being generated from the operations? What are the cash flows that are being utilized, right? For which all purposes, right? So that we can understand how the cash is moving within the organization. So it tells the ability of the entity to generate cash and cash equivalents during the period, right? And also it also tells us that suppose if a company is showing up a profit, as per the statement of P&L, say for example, say 1,000 crore net profits, right? But if we look at the cash flows from operations, that is not, saying that enough cash is generated, right? Suppose the cash flow from operations is 500 crores, while the net profit is 1,000 crores. Now, there is a stark difference between the two figures, right? So if the cash flow from operations is not near around the net profits, it means either the company is not able to realize its sales fully during the year if they have made the sales to the creditor debtors on credit, right? Or might be, there are some accounting adjustments which is showing up the profit as a, higher, right? So generally, cash flow statement tells us what is the quality of the profit and loss statement, right? What is the profit which company is showing up as profits earned during the year? What is the quality of those profits, right? So cash flow statement supports, the claim made by the company in the profit and loss statement, right? So cash flow statement tells investors how, company is able to generate cash, right? What are the timing and what is the certainty of the cash flows, right? So with these additional piece of information, investors will be able to take more informed decisions whether they really want to invest in a particular company or not, right? So if the cash flow statement shows the healthy signs, then it means the company's fundamentals are very good, right? So cash flow statement is very niche statement which uh, equips investors about the profitability and about the strength of the company on the fundamental part, right? Now, while we are preparing the cash flow statements, so we generally, prepare the cash flow statements by two methods, right? So either the direct method or the indirect method. So generally, largely, all the companies follow the preparation of the cash flow statements by indirect method, right? But what is the difference between the two, direct method and indirect method, if anybody is able to recall?
So direct method is like a top-down approach in that we will give the details of gross receipts of the in cash and
Mhm,
gross payments, and
mhm,
whatever the cash payments we will show it separately.
mhm.
And indirect method, we will start with the net profit after tax or before tax. To that we will make the non-cash adjustments and everything, and we will arrive at the cash profit.
Perfect. Perfectly worded. So the direct method means when we start with showing up the operations of the company in the cash flow statement itself, right? So we will start with like whatever the revenue or the sales the company has generated, right? Whatever the cost of goods sold has been incurred, what are the other functional costs which the company has incurred, and then we come down from the top to bottom, right? But in the indirect method, we simply pick up the net profit, either the before tax or the after tax number from the statement of profit and loss account. Then we'll start adjusting the non-cash items and the other working capital changes in order to arrive at the cash flow from operating activities, right? Thereafter we showcase investing activities and the financing activities, which is largely the same under the both the methods, right? So the only difference between the direct method and indirect method is the arrival of the cash flow from operating activities, right? Cash flow from investing and cash flow from financing activities largely same under both the methods, correct? Okay, so when we talk about the operating activities, investing activities, and financing activities, right? So if I ask one question to you, which uh, of these three activities should be treated as a residual category? Suppose if you are not able to identify a particular transaction, whether this transaction should be financing or should be investing or should be operating, then which under which activity you will park that?
Operating activity.
Operating activity, right? So financing activities and investing activities are very clear, right? Which all activities to be regarded as investing and which all activities to be regarded as financing. Although all the activities are very clearly defined in the operating activities as well. We know for a certainty which is operating activity and which is not, right? But if still we land up in a situation where we are not able to clearly demarcate that whether this transaction should be the investing activity or the financing activity, then the operating activities would be considered to present that particular transaction. Is that clear? Okay.
Yes, sir.
What do you mean by investing activity? So we'll start with investing, financing, and then we will come to operating. So what do you mean by investing activities?
So investing activity is the cash flows related to acquisition of assets or disposal of assets
Mm-hmm.
and the investments we make.
Mm-hmm. Right. So any long-term assets which are being acquired by the company, whether those assets are the property, plant, and equipment under Ind AS 16, or those assets are the intangible assets under Ind AS 38, or those assets are the investment property under Ind AS 40, right? So all these assets, because they are acquired, by the company, so company has invested funds in acquiring those assets, right, which they will use for the business purpose to generate future economic benefits from those assets for the company, right, going forward. Now, so company is making an investment into these assets on day one with an objective to realize, some additional sales or additional profits or additional cash flows, whatever, right, or additional cost savings in terms of the company's operations. So over the next few years. So this is the investment company is making today. So that is regarded as an investments made by the company. So whatever the cash the company has paid to the supplier of these machineries or these intangible assets or these investment property or other investments, maybe in equity shares or in bonds of any other entity, right? So whatever the cash the company has paid to acquire this will be considered as the cash outflows, right, from investing activities. And if the company has sold any of the fixed assets or property, plant, and equipment, intangible assets, investment property, or the shares or the bonds which they have invested in of any other company during the year, then it means they are realizing the cash by selling these assets. So though that will be regarded as cash inflows from investing activities, right? So because either the company is making the investment or company is realizing those investments, so all these cash inflows and cash outflows needs to be presented under the investing activities, so that users of the financial statements, right, will come to know which all investments company has purchased during the year and which all investments company has realized during the year, right? So that's the objective. Now my point is, suppose if the company has made an investment in any of the bonds of another company and they are receiving any interest on that bond, where you will present that interest received during the year, investing or operating?
Investing activities.
Investment.
Yes.
It's related to bond. It will the loan is raised through bond, then it will be the financing activity.
Sorry, please repeat.
Sir, what is the ask of the question, sir?
Ask is if you are receiving any interest on your investments, right, where that interest will be presented in the cash flow statement.
Yeah, it will be an investment activity.
Sure.
It depends of the business activity. If it is a banking institution, then it is operating. Otherwise, it will be the other for the other entity. It is a investing activity.
Okay. So if it is a financial institution nature of business the company is carrying, right, then any of the interest received, right, on the loans given, right, suppose loans given by the banks or the NBFCs, right, then you are saying that that will be coming under operating activities. And if the company is not in the financing business, right, and it is a manufacturing or service company, then it will be under investing activities, right? That's your answer.
Yes, sir.
Okay. Correct. So interest, for banks, suppose if you are preparing the statement of cash flows for any of the financial institutions, right? So for these financial institutions like banks and BFCs, right, or mutual funds or these type of companies, so money is the product for them, right? So they are actually running the operations on the money only. They don't have any other product, right? So for them to give the loans and earn the interest is the business, right? So bank give loans, right? Personal loans, home loans, business loans, right? MSME loans. So they give the loans and they earn the interest. So interest earned on these loans given will be regarded as the operating activities only, Correct. But for other companies, for example, Tata Motors, Reliance Industries, Infosys, TCS, all these companies are not in that business, right? So if they have given out any loans to any of their subsidiary or any other, party by any chance, and they are earning any interest, or if they have subscribed to the listed bonds or unlisted bonds of other companies, and they are earning the interest on those bonds, then that will be presented under the investing activity. So while, suppose if you are getting any question in your examination for the preparation of the statement of cash flow, so it is important to see the company is into which business, right? So might be you end up preparing the cash flow statement correctly and it is reconciling, but because you didn't pay the attention to the nature of the business of the company in the examination question, and you end up classifying one or two items here and there, right? And then the marks will be deducted in spite of the fact the cash flow statement is tallied, right? Because anyway the cash flow statement will be tallied whether you present it under the operating activity or the investing activity, right? So there is no doubt that cash flow statement will not work or will not tally. But the point is whether we have done the right presentation or not, right? So note down that it is important to understand if we are required to prepare the cash flow statement, for which company we are preparing it, whether it is a bank or NBFC financial institution type of company, or whether it is a manufacturing or service industry type of company, right? Because it makes a difference in the presentation in the cash flow statement, right? Financing activities. What do you mean by the financing activities? So financing activities basically, finances the activities which finances the business, right? So every business needs some capital, right? So that capital can either be raised in the form of equity or can be raised in the form of debt or both, mix of both, right? So suppose if a company is issuing shares during the year, be it a initial public offer, or it is a further public offer, or it is a bonus issue, or it is a right issue, or it is a private placement, right? By whatever name called, where you will present this item, this transaction. Financing,
Yes, sir.
because we are raising the finance for the company, right? And if you are taking the loans from any of the lenders or the bankers, again financing, because we are raising the debt finance in this case. So whether we raise the equity finance, whether we raise the debt finance, right? Both activities will be covered under the financing activities. And similarly, if we are repaying any of these capital which we have financed earlier during the year, then that also will be under the financing activity. Now the dividends paid to the equity shareholders or the preference shareholders, where you will present that dividend payments.
Finance activity.
Sorry,
Finance activity.
financing activity. Any other answer? Others?
Same, sir, financing activity.
Sure.
Both, as sir, both for financial institutions and non-financial institutions.
Right. So for both the institutions, whether it is a bank or NBFC or otherwise, right, it will go under the financing activities, right? Now, coming to the operating activities, then what operating activities will constitute? So operating activities will constitute all the activities which are incidental for the running the business successfully, right? So all the working capital changes anyway will be form part of this, right? But apart from that, what other items you will see? For example, income tax expenses for the organization, unless and until that income tax expenses is specifically related to the capital gains earned on the selling of the assets or the investments during the year, right? So income tax expense generally presented under the operating activities, right? But we need to see what is the color of the income tax. Suppose if we have realized or made the sales of any, shares or bonds or debentures during the year, and on those investments we have made some profits, right? So on those profits we need to pay income tax, correct? Now that income tax which is chargeable on those capital gains of equity shares, bonds, or debentures, right, will be presented under the investing activity only, right? But remaining income taxes, which are related to the uh, profits of the company, right? Remaining profits of the company will be presented under the operating activity. Are you able to recall this? You must have practiced it in few of the numericals,
Yes, sir.
right? So we need to simply see if there are any transactions in the question which are giving any gains realized out of the investments retired during the year. Then if there are any income tax adjustments to be made for that particular item, those will also be presented under the investing activity, and the remaining income tax will come under the operating activities. Correct? Now, operating activities are the principal revenue producing activities of the entity other than the investing or the financing, right? So operating activities is defined by the standard as principal revenue producing activity, right? So the ideally the objective of operating activity is that company is able to earn revenues, right? What is the business, whatever is the business of the company. Now, all these will be reported under the operating activities, and as I previously said, whatever is not classified under investing and the financing will automatically come to the residual category, which is the operating activities again, right? So this is how we are going to structure our cash flow statement into these three activities, right? Now, once we are done with the computation of the cash flows from all these three activities, whether it is an inflow or it is an outflow, right? Then we will total up whatever is the net position. Suppose the net position is outflow, or suppose the position is inflow, right? The last adjustment, what we will do after this, so we will add the opening cash and cash equivalents, right, as per the balance sheet, and we will arrive at the closing cash and cash balance, which ideally should be tallied with the balance sheet. Now, if it is tallying with the balance sheet, our cash flow statement is reconciled. But reconciling a cash flow statement can guarantee whether the cash flow statement is correct. What do you feel?
Yes, sir.
Yes.
But sometimes there can be differences in the classification of amounts.
Correct, correct. So if your cash flow statement is reconciled, it largely means that all the transactions which should have been, considered are considered largely, right? But it doesn't guarantee you that whichever items needs to be presented under the operating, investing, or financing, you have presented them well, right? Or correctly. So presentation could be here and there in spite of the fact the cash flow statement is being tallied, right? So only by getting the cash flow statement tallied, we shouldn't be believing that our cash flow statement is 100% correct. We should also pay attention to whether we have classified all the transactions into these three categories correctly or not, right? So that is the another piece which we always keep in mind. Now, what do you mean by the cash and cash flow equivalents?
Sir, it is a short-term and highly liquid and convertible to the known amount of cash without the insignificant risk.
Correct. So cash means cash on hand. Cash means bank balance, right? And cash means foreign currency if by any chance you hold. Cash means the bank balance in the foreign currency if any you have. That's correct. So that is called clear cash, right? Apart from this, any short-term highly liquid investments. What do you mean by short-term highly liquid investment, and what the short-term means here? 1 month, 3 months, 6 months, 9 months, 12 months.
3 months
The
from the
three
date of
months
3 months from
acquisition
3 months from which date? From the
date,
balance sheet date or from any other date?
date of
date of
acquisition.
acquisition.
Date of acquisition. So when those investments were acquired from that date, if the maturity is within 90 days, right, then it will be regarded as the cash equivalent because they are highly liquid investments. But if original maturity was for more than 3 months, but when you are preparing the balance sheet or the cash flow statement, the remaining maturity is less than 3 months, in spite of the fact it is less than 3 months, they will not be regarded as the cash equivalents. Is that correct?
Yes, sir.
Right? So we need to pay attention to the details given in the exam, right? On these things, right? If the original maturity is for more than 3 months, then those will not be regarded as the cash equivalents. It's always original maturity, right? Not the maturity from the maturity period from the balance sheet date. Any are the readily and they are readily convertible to the known amounts of cash. Known amounts of cash. What does this mean? So basically, because we have made the investment and the investment value is not fluctuating, right? Suppose if you made the investment in the equity shares, right, with an intention to sell it in the near future, right? Then are you able to say or demonstrate that how much value you will realize? No, because the equity shares value, fluctuates significantly, right? So you can never say that what value you will realize for sure, right? So it depends on the closing market price or the traded market price on that particular day when you are actually selling those investments. But in case of, say RBI bonds, SBI bonds, or any other debentures or any other fixed, instruments, fixed income instruments. So you can clearly say that this much I will realize, right, on this particular day, because on maturity, the principal plus interest will be paid to you by that institute, right? So cash equivalent has a feature that, first of all, they are highly liquid investments. Number two, for a certainty how much cash you will realize, right, whenever you realize those investments. And they are subject to insignificant risk of change in value, right? Insignificant risk. So their maturity value doesn't change, or if changes, that is almost insignificant, right? Are not for investment purposes, but it is a style of managing the cash so that our cash is not sitting idle and we are earning at least some interest or some, time value of money on that. So with that objective, we made these investments, and these are not our long-term investments, and has a short-term maturity of 3 months. That is from the date of the acquisition itself. So these are the five key attributes of the cash equivalents, and whatever item is meeting all these attributes will be regarded as the cash equivalents for our cash flow statement purposes. We can include that. Now there is an exception. Equity investments, so anyway, always excluded. We can never consider equity investments, right? But suppose if a company is, taking a overdraft from the bank. Now, you have two choices. Either the overdraft needs to be forming part of the cash and cash equivalents, or it will be forming part of current liabilities, correct? Now, what do you do with the overdrafts? Whether you would adjust it with the cash and cash equivalents, or you would ignore that.
Adjust with cash and cash equivalents.
Sir,
Always.
sir, if it is a
When
integral,
it is
if it is a form part of the integral part of that cash management, then we will include. Otherwise, we will not include it.
Correct, correct. So now again, one more, careful, point comes, which we need to keep in our mind while preparing the cash flow statement. Suppose there are the bank overdrafts given in the examination question, right? Now, if the question is silent, the question doesn't say whether, it is a part of integral cash management policy of the company or not, right? Then you have the choice whether you treat it as a cash and cash equivalents, or you treat it as a current liability, right? With an assumption noted in your working notes that we have assumed, right? But if the question specifically says that this is not part of the integral cash management policy or investment process, right? In that case, can you adjust? No. Is that clear?
yes, sir.
So if the question is silent about the company's policy to, treat the overdraft as a part of the cash and cash, integral part of the cash management, right? Then you have the choice. You can quote your assumption and accordingly treat. But if the question is clear that yes, it is a part of the integral part of the cash management, then you cannot deviate from that fact, right? And you need to treat it accordingly. right? So if it is a part of the integral cash management system, then it will be adjusted within the cash and cash equivalents. And if it is not, then it will not be adjusted, right? So that is the guidance given in the standard. Clear? What are the examples of cash flow from operating activities? For example, sale of the goods and surrendering of the services, right? Receipts from the royalty, commissions, or any other similar revenues, payments to the suppliers of the goods and services, or payments to the suppliers of the fixed assets as well. Payments to the suppliers of goods and services only, right? So if we are making the payment to a supplier for purchase of fixed assets, then that will go where? That will go under the investing activity.
Investing.
And if we are making the payment to a supplier for the goods and services, that will go under the operating activity. And by chance, if in the examination the supplier is same, he has supplied the raw material as well to you as well as one of the machinery, right? Then what you will do? The whole payment will go to the operating, or the whole payment will go to the investing, or you need to adjust it according to the value of the raw material and the machinery.
We need to adjust the amount.
We need to adjust, right? So all these, adjustments we need to be very careful about, right? Now, whether you adjust or not, whether you park the whole amount under operating or under investing, anyway the cash flow statement will tally, right? Cash payments on behalf of employees, to or on behalf of employees, salaries and wages payment, operating, yes or no? Yes. Bonus payments to employees, operating. Diwali gifts, operating. Any annual function celebration expenses, operating. So anything which is not investing or not financing, by default, it will be operating. So similar other examples are there. So these are just examples, not the exhaustive list, right? And for investing activities, for example, you are purchasing the machinery, you are purchasing the land, you are purchasing the any plant or factory, you are doing any installations in the factory. So all that stuff which results into the capitalization of any of the asset to your fixed assets will result into investing activity. And if you are discarding any of the assets, fixed assets during the year, then that will be the cash received on the sale of the property, plant, and equipment. Similarly, if you are purchasing the equity instruments or the preference shares of other companies, investing, you are realizing them, investing. If you are purchasing any bonds or debentures of any other company, then again investing, selling them for cash, again investing, right? Interest received on these investments, investing, provided the company is not the bank or the NBFC or financial institution, right? Now, financing activities, we already discussed: issuing share capital, issuing debentures, issuing bonds, short term, long term, by whatever frequent, for whatever duration, doesn't matter. If we are raising the capital either in the form of equity or in the form of debt, it will come under the financing activities. Or if we are redeeming any of these preference shares or the debentures during there, it will come under financing again, right? Clear? Okay. So let's see the interest and dividends chart quickly. So cash flow from interest and dividends received and paid shall each be disclosed separately. So in case of other entities and in case of financial institutions, right? So that is the breakup of all the companies into two categories. So in case of other entities, dividends paid, financing. In case of financial and institutions, dividends paid, financing. So for both, whether it is a financial institution or not, dividends payment will always be treated as a financing activity because it is paid as an expense for financing our business, right? So dividends paid, always financing. Interest paid by other entities, financing, but interest paid by financial institutions, operating. Why? Because for financial institution, for banks, what the banks are doing, so banks are receiving the deposits from the general public like you and me. So we park our balance with the bank, whether in the form of savings account or the recurring deposit account or the demand deposit account or fixed deposit account, whatever it is, right? Now when bank collects this cash from the millions of the customer, they pay interest to them, yes or no? Yes. So that interest which the bank pays to the general public on their deposits is a interest expense for the bank. Now bank is using that fund to you know di- uh, distribute the loans, education loans, marriage loans, business loans, personal loans, home loans, vehicle loans, right? All that stuff. And they earn the interest. So their objective is to earn the interest by utilizing these funds on which they are making the interest payments, right? So the interest they are earning is regarded as their revenue. So the interest which they are paying on these will be regarded as their expense. So it is all part of their operating activities. So whether they are receiving the interest or they are making the interest payment, it will be under the operating activities for the financial institutions, right? Similarly, for the financial institutions, if they are receiving any dividends on their equity investments, so that again will also come under the investing activity. While the dividends received by the non-financial institution companies, for example Reliance Tata Motors, for them it is a return on their investments, so that will go under the investing activity. Clear? Any confusions here?
So how come the dividend received from the financial institution is form part of the operating activities?
So for the financial institutions, what is happening? So they are making the investments, whether they are earning the interest on them or they are earning the dividends on them, right? So they make investment because their business is to make the investment, right? So for them, it is a business, right? So they are earning money by investing money, and that is their core business. So that's why interest and dividends both received on any of their investments will be regarded as the operating activity. But for the non-financial institution, the purpose is not to invest money in any of the financial assets. The purpose is to generate more sales by investing money in factories, in plants, in machineries, rather than in the bonds or debentures of other companies, right? So here the objective is different, right? The objective is to conduct a manufacturing or service business, rather, you know, investing the money which we have received from the shareholders in certain financial assets and earn interest or dividends, right? Although for the time being, when we are not sure where to invest, certainly we shouldn't be keeping the funds idle and we need to park that fund somewhere. And if we have parked those funds somewhere and interest dividends we are earning on that, that will be our investing activity only for the manufacturing and service industry. But for the financial institution, it is always to invest money, right? So they are earning because of their investments only. If they don't invest, they will not earn. And that's the prime objective, right? So that's why it is a operating activity for them, and for others it is a investing activity. Clear?
Yes, sir.
Okay. Then you must be able to recall that sometimes it happens that company is acquiring a interest in another company, right? And later on they further acquire the interest and eventually taking the control of that company, right? So if the company is acquiring a controlling stake in other company, right, where it will go? Operating, investing, financing?
That portion will be in
Investing,
it will be in financing activity.
investing activities.
The first part when they're investing, it will be go to investment. After taking the control, it will what are the further acquisition, it will move to financing activity.
Perfect. So unless and until we have acquired control and we are making any investments, those will be regarded as investing. But after you have acquired the control of another company and thereafter you make further investments in their equity shares, then that will be presented under the financing equity, and that is the requirement of this standard. So this standard asks us to present this transactions like this, we will do that, right? And similarly, the losing of control. Until the control is lost, right? If we are realizing any shares, then that will be under the financing. And if we are losing the control, that will go under the investing, right? Because we are realizing our investments from that company, right? And we will do a numerical around this as well. So that was the quick recap of the standard which we had studied, right? Now we'll start with the practical questions. So let me reshare my screen. Once it is visible, please confirm me.
Visible, sir.
Visible? Okay. So let's do the question number 1, and it is all about the various items which we need to classify, right? Company has provided the following information regarding the various assets held by the company on 31st March 2001. Find out which of the following items will be part of the cash and cash equivalents for the purpose of preparation of the cash flow statement as per the guidance provided in Ind AS 7. So we just need to tell where we are going to present these items. Fixed deposits with State Bank of India, 12% is the rate of interest, 3 years is the maturity on 1st of January.
So
Yes.
long-term investments, not included in cash and cash equivalents.
Okay. Investing activity, right? Fixed deposit with HDFC, 10%. Original term was for 2 years, but due for maturity on 30th June.
Same, sir, this is also long-term investment.
Okay. Investing. Long-term investments not part of the cash and cash flow, right? Equivalents. Redeemable preference shares in ABC Limited. Acquired on 31st January 2001 and the redemption is due on 30th April. Yes.
Sir, cash and cash equivalents.
Cash and cash equivalents. Okay. Cash balance at various banks. All the branches of the banks in India.
Cash and cash equivalents.
Okay. Cash balance at various banks. All the international branches of the Indian banks.
Cash and cash equivalents.
Okay. Bank overdraft with the SBI Fort branch. Temporary overdraft which is payable on demand.
Cash and cash equivalents.
Cash and cash equivalents.
Yes,
Okay.
sir.
And this one, sixth one, sorry, it was missed. Cash balances at various banks, branches of the foreign banks outside India.
Cash and cash equivalents.
Okay. Treasury bills, 90 days maturity.
Cash and cash equivalents.
Everybody is aligned with this? Or any different opinion for any of the item? Okay. So let's see.
So only
So
the thing
first,
is that the bank overdraft, if it is a form part of that integral part of the cash management, then we can include. Otherwise, we will exclude it.
right. So for the bank overdraft, correct. So what we have done, assumed as an integral part of the entity's cash management. And this assumption you always need to quote if the question is silent, right? Don't include without this assumption and don't exclude if the question says that it is a part of the entity's cash management, right? So the choice is yours whether to include or exclude if the question is silent. But whatever choice you are making, you need to tell that in the form of your assumption, right? Okay. Now, if the question is silent, which assumption you will prefer to make?
I will assume as an integral part of the entity's cash management.
Okay. Same for others?
Yes, sir. I will also assume the same.
Correct. Correct. Because by assuming this side, we actually want to showcase about our awareness about this item, right? Because if we are including this in the cash and cash equivalents, then we are indirectly telling to the examiner that we know that this is the deviation under the Ind AS as compared to the IGAP, and Ind AS allows to keep this item as a part of the cash and cash equivalents, and hence we are keeping it, right? Because under the IGAP it is anyway not allowed, correct? Okay. So rest all answers are already correct, which we have done. So let's move to the question number 2. So now just keep your calculators and the notepads ready because you are going to prepare the cash flow statement. The balance sheet is given. Other adjustment items will also be given. I am reading the question for you. You just make notes of key adjustments and then start with the preparation of the cash flow statement. So following is the balance sheet of the Kuber Limited for the year ended 31st March 2002. So 2001, 2002. Okay, one more thing I just wanted to touch base, which we need to be, very careful while preparing the cash flow statement in the examination. Sometimes, in the question, the current year balance sheet is presented here and the previous year presented here, right? But sometimes, question reverses the order. So it presents 2001 here and 2002 here, right? And because we are, very much in the, stress in the examination hall that we need to complete the paper in the dedicated slot of 3 hours. And because we know for a certainty that if we spend more time on any of the question, it will be at the cost of the other questions, right? So sometimes in hurry burry, we don't pay attention that which order the question has given the balance sheet, right? And while making the adjustments for the working capital changes, right? Deductions from current year balance minus previous year balance. So all those adjustments goes wrong. Why? Although the amount will anyway be correct, whether you deduct 145 minus 170 or 170 minus 145, right? But what it will make the difference? The plus or minus sign, right? Increase or decrease. And all the adjustments will go in the opposite order. And in spite of you knowing the standard, completely knowing all the concepts, already done the practice and making the right things in the examination, but just because of error of sight of this flip in the question, your cash flow statement will go on toss. Correct? Am I making sense?
Yes, sir.
So just pay attention before you actually start jumping on to making the adjustments, right, of working capital changes. So in the question, it is correct. This is the 2002 and this is the 2001, but sometimes the order reverses, right? And our question goes wrong. Okay, let's start. Property, plant and equipment. Intangible assets, other financial assets, deferred tax assets, nets, other non-current assets, total non-current assets, current assets, financial assets, investments, cash and cash equivalents, other current assets, total current assets. So all these balances are given, right? Now, equity and liabilities. Equity share capital, other equity, total equity. Liabilities, non-current liabilities, financial liabilities, long-term borrowings, other non-current liabilities, and total non-current liabilities. Right. So we are very much familiar about all these items, right? As such, no complexity until now. Trade payables, bank overdrafts, right? So bank overdrafts have arrived. Other current liabilities and total liabilities. Now, these are the additional information. Profit before tax for the year ended 31st March 2002 is 4450 lakhs. Dividends paid during the year 450. Depreciation on PP&E 500. On intangible assets 20. During the year ended 31st March 2002, two machines were sold for rupees 70 lakhs. The carrying amount of these machineries as on 31st March 2002 is 60 lakhs. Income taxes paid during the year 105 lakhs. Other non-current or current assets and liabilities are related to the operations of the Kuwait and do not contain the element of the financing or investing activities. Using the above information of Kuwait Limited, prepare a statement of cash flows under the indirect method. Right? I think question is very simple. As such, there is no complexity I can see in this question. If you have, studied this standard and uh, practiced a few of questions, you must be able to come out with the preparation of the cash flow statement. So I'm giving you complete 10 minutes for this. It's 7:50. 10 minutes for you just to start preparation of the cash flow statement along with supported by the working notes so that you can gain confidence whether you are making the adjustments right or not, and if you are making any mistakes in the classroom, then certainly you will avoid them in the examination. Your time starts now. We will discuss the solution, we will discuss all the adjustments. Just I want to give an opportunity to all of you to try this one, because anyway we are spending time, right? So at least we come to know where are we on the concepts. Theoretically might be we are aware of everything, but when it comes to applying them practically, we are lacking behind by any chance. Then we need to clear or fill those gaps. Is that fine? Are you trying?
Yes, sir.
Perfect. Let me know if I need to move to the balance sheet page if you have noted down these adjustments or taken the screenshot of this.
Just move up, sir.
Okay, everybody has noted down and taken the screenshot.
Yes, sir.
Okay, now I'm moving to the balance sheet page. And certainly in the balance sheet as well, it is coming in the 2 pages. Or maybe I can reduce a little bit font size if I hope you are on the laptops and not on the mobiles.
Yes, sir. I am on the laptop.
Okay. So this standard is all about practice, right? No theoretical question is expected from this standard. If any question comes from this standard, it will be a full-fledged practical question on only, most likely. If I need to change the page, just let me know.
Sir, can you scroll it down if it is okay
Sure.
for others?
Whenever you are ready, you can let me know that you are ready and you have prepared the cash flow statement. and then we will discuss the solution and you can match if all the amounts are correct in your cash flow statement. G. Where we reached? Operating activities cash flow is right. Yes, no.
Yes, sir.
Okay.
4025.
What about you, Saminathan? You there? Or went on break? Okay. So let's see what all we need to do here. And then certainly you can match your solutions. So let's start with net profit after tax given already in the question 4450, right? and we will make the first adjustment as the tax is paid because we need to come to the net profit before tax, right? 4555. Then we will add the depreciation and amortizations, right? So for the depreciation and amortizations, what are the amounts given in the question? Here it is. Depreciation and amortization charged in the statement of profit and loss account during the current year are as under PP&E 500 and intangible assets 20. So 520 we have added, correct? And the gain on the sale of machinery have deducted and increase in the deferred tax asset. So deferred tax asset change is given in the balance sheet. Where it is, where it is. Here it is, 855 minus 750, right? So we did this adjustment and we came up 4960 as the uh, amount after adjusting these non-cash items, right? All these items are non-cash, yes or no? Non-cash,
Yes, sir.
right? So all these items are adjusted. We arrived at this amount. Now we'll start making the working capital change adjustments, right? So we will do these adjustments for the decrease in the financial assets, increase in other non-current assets. So current year balance minus previous year balance, current year balance minus previous year balance. Now, once we have done all these adjustments for the assets and the liabilities uh, into our cash flow statement presentation, we will be able to come to the cash generated from operating activities. Certainly, we will deduct the income tax again because this income tax expense now needs to be deducted by way of presentation under the operating activities because we don't have any information available in the question if there is any tax pertaining to any of the capital gains, right? So we assumed the whole tax is the tax on business income. So it is presented here 105, right? Now, until here, any challenge or any mistakes we have done by any chance? These working capital changes, adjustments, you know how to make or, or consider these. Any doubts on these adjustments? Because these are the simple delta of these items from the balance sheet. Current year balance minus the previous year balance.
Clear, sir.
Clear? So 4025 is arrived. Now we need to come to cash flow from investing activities. Now we have made a sale. For how much we have sold this machinery, how much cash we have realized? 70. It is already given in the question. Yes or no?
Yes, sir.
Right. So 70 we will consider here. Right. Now, purchase of machinery. How much given in the question? No, it is not given in the question. By any chance, anybody thought of this?
Yes, sir. By preparing ledger accounts, we will get the balancing figure.
Correct, correct. So we will always, so whenever, these type of adjustments are there, we will always prepare a ledger account quickly to understand where are we, right? So in the question adjustments, what is given? What information we have? So we will go to the balance sheet quickly, and here we will see what is the information available. So 13,000 is showing up as the current year balance, 12,500 is showing up as the previous year balance. Apart from this, there is a depreciation which we have charged during the year is how much? 500, right? So can we figure it out quickly if there is any purchase? So 13,000, the closing balance minus the opening balance of 12,500 minus the depreciation. So 12,000 minus 13,000, 1,000. And within this, 60 adjustment is also made. Why this 60? This is the carrying amount of machinery sold. Yes or no?
Yes, sir.
So carrying amount of machinery sold and the depreciation during the year are reducing my PP&D balance. And what was my opening balance? 12,500. So 12,000 minus 500 minus the depreciation during the year minus the carrying amount of the machinery sold. And this I will compare with the closing balance. And because my closing balance is still coming higher, so the delta is the purchase. So new purchase of machinery, correct? Everybody's clear on this adjustment?
Yes, sir.
Same adjustment for the intangible assets as well. So what is my closing balance? 50. What is my opening balance? 30. And how much the amortization I have charged? 20. So 30 minus 20, 10. 50 minus 10, 40. So 40 is the new purchase of intangible asset during the year. So these are the hidden pieces of information which we need to find ourselves by constructing the ledger of these items. So what is the key learning from this question? So whenever we are preparing the cash flow statement, we need to be very careful to reconcile the PP&D, intangible assets, investment property, ledger accounts carefully, even if the question doesn't talk about, if there are any purchases during the year, right? Right. Otherwise, what would have done? If we don't construct these ledgers, we will not be able to find these purchases, right? And we would have simply ignored this, right? Because the question is silent, right? About any of the purchases. The question was telling about only the sale, and that sale of the machinery we have already considered here, right? So adjustments already taken care, but these two adjustments will be missed if we don't construct the ledgers to derive these purchases ourselves, and our cash flow would have never tallied, right? Now the sale of the financial asset investment, so that is also given in the question or not? So it is not given. So within the balance sheet we just need to check. Yes. So what is happening? My last year investment was 2,500 and my current year investment is 2,300. So it means I have sold 200 worth of investment during the year. So it is depicted in the balance sheet itself. So I find it out and I made an adjustment. Sale of financial asset investment during the year 200. Cash outflow from investing activity is arrived. Any doubts on this 830?
No, sir. Clear, sir.
Clear? Now cash flows from financing activities. So dividends paid anyway given in the question, and long-term borrowings paid, balance sheet adjustment, current year balance minus previous year balance. Very simple. So this 3450 also arrived. Now net cash flow outflow from all activities. So summing up these three activities will give me 255 negative, right? So this is the net cash outflow during the year. Now, operating cash and cash equivalents balance 460 minus 60. What this 60 is? Overdraft,
Overdraft, sir.
right? So we have made the overdraft adjustment here. So 400 we have considered, and then 255 plus 400, 145. Luckily, this 145 is telling with my balance sheet. Yes or no?
Yes, sir.
Right? So what are the key learnings from this question, which we are writing on our notepads for our future reference and revision, quick revisions? Number one, while preparing the cash flow statement, we have to be careful about the year, this one, which I mentioned in my questions discussion, right? When I was reading the question, right? Number one learning, we have to pay attention about the years, whether they are in the order or they are flipped, right? Number two, we always need to construct the ledgers for few of the items. For example, property, plant and equipment, intangible assets, investment property, right? All these items, because there might be the hidden purchases which is not, clearly given in the additional information in the question, so that we need to work out ourselves. Number three, because in this question, overdraft adjustment uh, was not, told whether it is being adjusted, whether it is forming part of the integral part of the cash management or not. So we have assumed it and we adjusted it from the cash and cash equivalents, right? So we need to quote this assumption as well, right? So these are the few learnings from this question which we need to note down somewhere. Okay. So you want to do the question number three first, or you want to have a break first, because this is a very small question. So maybe we can finish it first and then we go for a break. Or if you are already exhausted, then we can go for a break now and come back and do this, whatever you suggest.
Yeah,
We
we
can
will finish
finish.
it.
Continue. Okay.
Yes.
Z Limited has no foreign currency cash flows for the year 2001. It holds some deposits in the bank in the USA. The balances as on 31st December 2001 and 31st December 2002 were US dollar 1 lakhs and 1 lakh 2000 respectively. The exchange rate on 31st December 2001 was itna, $1 is equal to 45, and on 2002 $1 equal to 50. The increase in the balance was on account of the interest credited on 31st December 2002. Thus, the deposit was reported at 45 lakhs in the balance sheet as on December 2001 and at 51 lakhs as at December 2002. How these transactions should be presented in the cash flow for the year ended 31st December 2002 as per Ind 7. So what transaction we are talking about here? So we have a deposit in a foreign bank, right? Denominated in foreign currency, US dollar. How much is the opening balance? $1 lakh. How much is the closing balance? $1,02,000, right? And the rates are 45 rupees per dollar and 50 rupees per dollar for 2001 and 2 respectively. And in our balance sheet, prepared in INR currency, 45 lakh is the amount of this deposit presented on 2001. That is $1 lakh into my 45 lakhs, and $1,02,000 into my 50. So 51 lakhs, right? So these are the balances stated. Now, balance sheet, we understood how this needs to be presented in our cash flow statement, that we need to explain. So we don't need to prepare the cash flow statement here. We just need to discuss how we are going to present this. So what is your thought?
Sir, my thought is they put some deposit 1 lakh USD and it's grow 1,02,000. The difference is 2,000 USD dollar is by of interest. Interest will be the investing activity.
Hmm.
The 2,000 in 45.
Hmm.
The difference is uh, 2,000 into 45. Sorry, 2000 into 50. Its initial deposited to be 50. Now it's 10 to 50. 2000 into 50, 1 lakh. It will go to the investing activity.
Okay. So
And
you are
yeah,
saying the interest of $2,000 which is received on a 1 lakh deposit during the year will be showcased under the cash flow on in the cash flow statement under the investment activities that interest received in the dollar currency denominated deposits, right? And the amount would be 2000 into my 50, that is 1 lakh rupees, you mean to say, correct?
Correct, sir. Since it is a X Limited, a limited company, it's not a banking or financial institution.
Okay. Anything else?
And the difference between the exchange difference, that the 45 and 50, the 5 rupees,
Hmm.
the between the 45 lakhs and the 51 lakhs, 1 lakhs goes to the interest income, and 5 lakhs difference is the it's due to the exchange rate fluctuation. It will be
Where
always
it will
debited to
be
the,
presented?
it will always the presented into the profit and loss account. It will be credited, though we need to reduce this income while we are preparing the cash flow from operation activities.
Hmm. Hmm. Okay. So 1 lakh of adjustment in the cash flow statement, you are saying 2000 into my 50, that is 1 lakh rupees will be presented as the interest received on the investments on the foreign currency denominated deposits under the investing activity, and the adjustment for 5 lakh rupees, that is 45 lakhs to 50 lakhs, right? That 5 lakh, which is because of purely dollar movement, will be showcased in the cash flow statement as a adjustment before we arrive at the cash flow from operating activities, right? Because it is already forming part of the net profits which we have taken out from the profit and loss account. Is that what you are saying?
Yes, sir, exactly.
Perfect. Any other thought? Same. Okay. Now, because in the examination, this is a descriptive question only, right? So we are not going to present any cash flow statement. Rather, we will present our answer in a paragraph form only, clearly articulating what we are doing. The profit and loss account was credited by rupees 1 lakh, that is $2,000 into my 50 towards interest income. It was credited by the exchange difference of rupees 1 lakh, that is 50 minus 45, 5 lakh rupees. So in our profit and loss account, there are two items of income. One, the interest credit of rupees 1 lakh, and one, the unrealized gain on the foreign deposits of rupees 5 lakhs. In preparing the cash flow statement, 5 lakh, the exchange difference should be deducted from the net profits before taxes. However, in order to reconcile the opening balance of the cash and cash equivalents with its closing balance, the exchange difference of 5 lakh should be added to the opening balance in the notes to the cash flow statement. Right? Now, what does this line mean? In order to reconcile opening balance of the cash and cash equivalents with the closing balance, the exchange difference of rupees 5 lakh should be added to the opening balance in the note to the cash flow statement. Because in my balance sheet, opening cash and cash flow will be presented at what value? 45 lakhs only, correct? And the 5 lakh adjustment we have already removed from the net profit above, right? As we spoke. So, for the purpose of reconciling my cash flow statement at the end, what I need to do, I will simply add this 5 lakh to my opening cash and cash equivalent balance in the cash flow statement, so that in the balance sheet, my cash balance is already sitting at what value? 51 lakhs, including the 1 lakh interest. So 50 lakhs in nutshell. So 50 lakh will be reconciled. So cash flow arising from the transaction in the foreign currency shall be recorded in the Z limited functional currency by applying the foreign currency amount, the exchange rate between the functional currency and the foreign currency at the date of the cash flow. So anyway, this is purely descriptive, but the key adjustment is sitting here, which we need to explain, right? Has this adjustment be understood? Clear? Yes, no? Okay. So let's have a break now. How much? 10 minutes would be sufficient. So let's have a 10 minutes break. It's 8:25. We will resume at 8:35. Okay, perfect. Okay, thank you. Chat box from the participants as well. Thanks, Lavanya, for the confirmation. Okay. So let's start with the question number 4. Company A acquires 70% of the equity stake in Company B on July 20, 2001. The consideration paid for this transaction is as follows. Consideration paid in cash 15 lakh and 2 lakh equity shares having face value of rupees 10 and fair value of rupees 15 is also given. So total consideration will be 15 lakh cash plus 2 lakh equity shares worth rupees 15 fair value and 10 face value. On the date of the acquisition, Company B has the cash and cash equivalents of rupees 2,50,000 in its books of account. On October 10, 2002, Company A further acquires 10% stake in Company B for a cash consideration of rupees 8 lakh. Advise how the above transactions will be disclosed or presented in the statement of the cash flow as per Ind AS 7. So this is the practical around the concept of the presentation of the uh, acquisition of the company, right? Controlling stake and the investment beyond the controlling stake in the second tranche, right? So we discussed it briefly. So what is your thought? How do we go about this presentation in the cash flow statement?
Sir, for the first transaction, the cash consideration of 15 lakhs
Hmm.
minus 2 lakh 50, which is already present in company B, the
Hmm.
difference amount of 12 lakh 50 will be shown as investing activity
Okay.
because we got the control over the company.
Hmm.
And with the second transaction, cash consideration of 8 lakh will be shown as financing activity.
Okay. And what about 2 lakh equity
And
shares, which we have?
2 lakh, we will just disclose it in some notes, sir,
Okay.
as it
So
is a non-cash consideration.
okay, because it is a non-cash transaction, so it has no nexus with the cash flow statement. At least from the disclosure standpoint of view, it will be disclosed somewhere else in the notes related to the acquisition disclosures, right? But in the cash flow statement, you are saying 15 lakh minus 2 lakh 15,000, that is 12 lakh 50,000 will be presented as the cash outflow on account of investment acquired in company B, and 8 lakh which we have paid after the control had already been acquired will be presented under the financing activity. That was your answer, is correct?
Yes, sir.
Okay. Any other thought?
Yes, sir, correct, sir.
Anji, same?
Sir, that 15 lakhs minus 2 lakh 50,000 will be for the investing activity, and that 8 lakhs will be considered as a financing activity.
Okay. So let's see how we are going to present our answer on this in the examination. So do we need to remember all the paragraphs and quote them? Not necessarily, right? But if we remember for sure that we are quoting the right para, then you can do so, right? So you can start as per Ind 7 rather than calling out the para number, right? But this is the suggested answer from the institute. So we will read it as per the para 39 of the Ind 7. The aggregate cash flows arising from obtaining control of the subsidiary shall be presented and classified as investing activity. And as per para 42 of Ind 7, the aggregate amount of the cash paid or received as a consideration for obtaining the subsidiary is reported in the statement of cash flow, net of the cash or cash equivalents acquired or disposed of as part of such transaction, events, or changes in the circumstances, right? So this is the professional language, right? We can be as much closer as possible. Further, investing and financing transactions that do not require the use of the cash and cash equivalents shall be excluded from the statement of the cash flow. Such transactions shall be disclosed somewhere else in the financial statements by way of notes so that it provides all the relevant information about these investing and financing activities, right? As per para 42A of India 7, cash flow arising from the change in ownership interest in the subsidiary that do not result in the loss of control shall be classified as cash flow from the financing activities, unless the subsidiary is held as by an investment entity as defined under Ind AS 110 and is required to be measured at fair value through P&L. Such transactions are accounted for as equity transactions and accordingly resulting the cash flows are classified in the same way as the other transactions with the owners, right? Now, considering the above facts, so this was all the literature of the three paras which we reproduced here. Now we will come to the conclusion. Considering the above guidance, for the financial year to 31st March 2002, the total consideration of rupees 15 lakh less 2 lakh 50,000, which is already there in the acquired company's balance sheet, right, will be deducted, will be shown under the investing activities as the acquisition of the subsidiary net of the cash acquired, right? So 15 lakh minus 12 to 50, 12 lakh 50,000. There will not be any impact on of issuance of equity shares as a consideration in cash flow statement. However, a proper disclosure shall be given elsewhere in the financial statements in a way that provides all the relevant information about the issuance of the equity shares for non-cash consideration. Further, in the statement of the cash flows for the year ended 31st March 2003, the cash consideration paid for the additional 10% stake will be shown under the financing activities, right? So your answer is correct, but how we are going to present in the examination, we can certainly learn from the suggested answers language, right? We might not be, very detailed like this, that quoting the entire para itself. Maybe we can simply say that as per the guidance given in the India 7, this is the guidance, and basis on the facts, this is the treatment, right? This is how we need to articulate. Perfect.
Sir,
Now,
in the
yes.
exemption is given us unless if it is an investment entity. If it is an investment entity, even the second investment also we will show it in investment activity, sir.
Right. So investment entities are which entities?
The entities which are mainly into the investment and they generate through
Same, the
interest and
banks, insurance companies, mutual funds, asset management companies, venture capitalists, right? All these entities
yes, yes,
which
sir.
are acquiring, the shares of other companies purely for their investment purposes. For
Mhm.
example, we invest, our funds in the mutual funds schemes, and mutual funds, using those funds which we invested with them, you know, uh, use those funds to acquire the shares of other companies, right? Now, imagine a situation where, a mutual fund, is so much, uh, you know, uh, I would say a fan of a company that it is acquiring, more than 50% stake of that company itself only for the investment purposes. So although mutual fund company doesn't intend to control that company, right? Neither it intends to control nor it intends to make that company its subsidiary, right? It is an investment only for them. But because they have acquired a controlling stake in that company, so generally that company will become the subsidiary of that mutual fund, yes or no?
Yes, sir.
Yes. But under India's 110 consolidation, there is a relaxation provided that because the mutual funds companies doesn't intend to control these companies or do or intervene into the day-to-day operations of these companies, they are acquiring this much stake only and purely for their investment purposes only, and hence they have the relaxation to measure them at the fair value through PNL rather than doing the investment rather than treating those investment in those companies which will be subsidiary otherwise as the subsidiary, right? So such transactions are accounted for as equity transactions, and accordingly resulting the cash flows are classified in the same way as the other transaction with the owners, right? So as the other transaction with the owners का क्या मतलब है? What does this mean?
Issuing equity or debentures.
Right,
Issuing
issuing equity.
equity.
issuing equity, right? So transaction with the owners means that I'm issuing shares or doing the buyback, right? So where are all those presented?
Financing activity.
Financing. So this will result into the cash flows classification under the financing activities. Clear?
Yes, sir. So that means I did not get for investment entity also we will classify it as financing. Sir, here the exception is given, no, sir, unless the subsidiary is held by investment entity.
So for the investment entity, so it is saying that when we result when we acquire a stake in a company beyond the controlling stake, this results into financing activity, right? Unless
Yes.
the subsidiary is held by the investment entity, right? So because the subsidiary is held by the investment entity, so they are doing the investment only, right? So for them it is always an investment, even before the acquiring of the control or the after the acquiring of the control.
Okay, sir. Got it, sir.
Getting my point? So for
Yes, sir.
investment entity it is always investment, but for normal entities it is until the acquisition of the control investing, post that financing.
Yes, sir. Got it, sir. Thank you.
Clear? Okay. Let's do the question number 5. Entity A acquired a subsidiary, entity B during the year. Summarize information of the consolidated statement of the profit and loss and the balance sheet is provided together with some supplementary information. Consolidated statement of the profit and loss. Revenue 380, cost of sales 220, gross profit, depreciation, other operating expenses, interest cost, profit before taxation, taxation and the profit after taxation. So this is the profit and loss statement and this is the balance sheet. So current year, previous year. Okay. Cash and cash equivalents, trade receivable, inventory, PP&E, goodwill, total assets, liability, trade payable, income tax payable, long-term debt, and the total liabilities, shareholders funds, and the total liabilities and the shareholders funds, right? So balance sheet total. Other information. All the shares of the B were acquired for 74,000 in cash. The fair value of the assets acquired and the liabilities assumed by the acquisition of B are as follows. So these are the values of the assets and liabilities which are acquired by way of acquisition of the company B during the year for a total consideration of 74,000 paid in cash. Prepare the consolidated cash flow statement. So consolidated P&L is prepared, consolidated balance sheet is prepared. You are supposed to prepare the consolidated cash flow, right? So when we say that consolidated P&L is given, it means it is including the P&L of the acquired company B. And when we say consolidated balance sheet, it means the line by line consolidation has already been made, right? Including the B's balance sheet, right? Now you need to come up and prepare the consolidated cash flow statement. So I'm giving you again 10 minutes for this. You just try uh, to prepare this statement on your own first, and then we will see if we have done it right or we made any mistakes or we are stuck somewhere and we are not able to proceed further. So at least that assessment needs to be made, right? Let me know if I want to scroll up or scroll down. Of course, not scroll down, only
Ye-
scroll up.
Yes, sir. PNL.
PNL. Okay. So maybe you can take quick screenshot of this PNL and then I will showcase the balance sheet.
Sure, sir.
Okay. Now I'm moving to the balance sheet. And this is the other information. So your time starts now. Just concentrate.
Sir, can you please put the balance sheet?
Balance sheet.
Yes.
The asset side or the liability side? Both. Both are coming on the same page.
Yes.
Anything by any chance? Anybody stuck somewhere with something or wants to clarify? Operating activity cash flow arrived. Yes, no.
Yes, sir. Somewhere I got difference of 1,000. 1,000 is
Uh,
not tallying.
1000 difference in the cash flow statement. So you have constructed the entire cash flow, all the three activities.
Yes, sir.
Okay. 1000 difference you are having. Okay. What about you, Samanathan? Still in progress? Need one more minute or ready for discussion? Okay. Let's see whatever we have done. So profit before taxation already given in the question 70,000. Non-cash items adjustments we will make first. So depreciation already given in the question 30,000, right? So these two figures are given. So no disconnects. Then decrease in the inventories, decrease in the trade receivables, and decrease in trade payables. Working note number 1, 2, and 3. Now, why we are constructing the working notes for this? So let's see what is happening in the working notes. Total inventories of the group at the end of the year, 30,000 given in the question. Inventories acquired during the year from the subsidiary, 4,000. So closing balance, 26,000. Opening inventories, 35,000. So decrease in inventory, 9,000. Have we done it correct?
Yes, sir.
Great. Then similarly, trade in receivables. Again, we need to construct the working note for this. So total trade receivables of the group at the end given in the consolidated balance sheet, 54,000. And trade receivables acquired during the year from the subsidiary, 8,000. 46,000 del arrived balance, and then we will minus opening trade receivable, 50,000. So it means trade receivable decreases 4,000. Is this also correct for you?
Yes, sir.
Superb. Third one, the trade payables. Similarly, for the trade payables, 68,000 is given in the question and 32,000 is assumed from the acquired companies. So 36,000 would have been the balance and minus opening 60. So the delta is 24,000. So this is also correct for you.
Yes, sir. I did mistake in that
Okay.
tax part, sir. I did not prepare the ledger account.
Okay, understood. Understood. So now these three working capital adjustments are all correct for you, right? So 9,000, 4,000, and 24,000. Now we will come to the interest paid to be included
Yes.
in the financing activities. So this 4,000 anyway given in the question, right? Now the taxation adjustment. So for the taxation, I guess you might have not done the uh, ledger construction for the income
Yes,
tax,
sir. Yes, sir.
because what is the difference between this question and the previous question? In the previous question, we have been given the clear amount of income taxes paid during the year, right? So that's why we have considered that item directly while preparing the cash flow statement, because it was already given as income taxes paid. But now in this case, we are not given the income taxes paid, but what we are given, income tax payable at the year end and income tax payable at the year of beginning. That is the last year balance. So two liabilities balances are appearing in the balance sheet, but we do not know how much we have actually paid during the year. So to arrive at that, we need to find. So closing balance is how much? 11,000. And the opening balance is how much? 12,000 in the balance sheet, where it is. So closing balance is 12,000, opening balance is 11,000, correct?
Yes, sir.
And where it is the other information.
Sir, in consolidated P&L, it is given taxation of 15,000.
I'm just finding that out. Hmm. So taxation provision which we have made during the year is 15,000, right? In the P&L. So with that amount, we can figure it out how much we have actually paid. So 15,000 provision we have made. 11,000 is the closing liability minus the opening liability. The actual discharge of liability during the year, 14,000, right? Now, net cash generated from operating activity, 79,000. This amount is correct. Now, cash paid to acquire the subsidiary, 74,000 minus 2,000. What this 2,000 is?
Cash balance already present in subsidiary.
Correct. So 72,000 is the net cash paid to acquire this subsidiary, and net cash flow from the operating activities is 72,000 after adjusting this item, right? So, or this is the only item for the investing, right? And then financing. Interest paid, information already given in the question, 4,000, right? So net cash outflow from financing, taken together all the three, we have the positive cash inflow of 3,000, opening cash, closing cash, correct? So the question is simple. The only thing or the key learning from this is that we always need to construct the ledgers of the income tax account whenever we are not given the clear amount of income tax payment in the question or additional information, and we are simply given the closing liabilities of the income tax in the balance sheet, then in that case we need to construct the account to find out how much actual payments we have discharged towards income tax during the year, right? And whenever, another learning from this question is that whenever there are consolidated balance sheet is given, then we need to identify the movement in the trade payables, trade receivable, inventories, all this, whenever there are any transactions with the subsidiary company as well, right? Factoring into those by constructing the ledger. So either you can construct the ledger or you can simply present your working notes the way it is being presented here, like this, right? So whichever way is more convenient to you, you can follow that. Okay, let's move to the next question. Question number 6. During the year 2019-20, Akola Limited have paid various taxes and reproduced the below mentioned records for your perusal. Capital gains of rupees 20 crore on the sale of the office premises at a sale consideration of rupees 100 crore. Income tax of rupees 3 crore on business profits amounting to rupees 30 crore, and the dividends distribution tax of rupees 2 crore on the payment of dividend amounting rupees 20 crore. Income tax refund of rupees 1.5 crore, refund on the taxes paid on earlier periods for the business profits. You are required to determine the net cash flow from operating activities, investing activities, and financing activities of the Akola. So here, what's the ask? The ask is not to prepare the cash flow statement as such. The ask is just to showcase what would be the operating cash flow, what would be the investing cash flow, and what would be the financing activity cash flow. That's all. So in this case, we might be presenting this in the tabular form, right? Without, you know, uh, uh, constructing the whole cash flow statement, right? Because we are not given that information anyway. So how we are going to do this? Simple. First of all, we have determined what all transactions are there. So 1, 2, 3, and 4. 4 transactions are there for which we need to make the adjustments. So let's do sale consideration 100 crore, right? What is that 100 crore? A capital sale consideration for the office premises. So it will be investing activity 100 crore, correct? 20 crore the capital gain tax on these sale consideration profits given in the question. Investing activity again, as I previously mentioned, if the taxes are related to the any capital gains on the investments realized during the period, that will go under investing activity only, correct? Business profits, operating activity 30 crore, and business taxation on the business profits 3 crore, operating activity again, correct? Then dividend payment, always financing activity, and dividend distribution tax paid on that, again a financing activity. And then lastly, income tax refund, always operating activity, right? So the net total cash flow would be 86.5 crore, and this is the split between operating, financing, and investing, right? And then you can summarize that what is the total of the operating, what is the total of the investing, and what is the total of the financing. Or maybe instead of making the two tables separately, you could have make it in one table itself. So you can, after the investing, you could have subtotal it here. Then after the operating, you could have subtotal here. And after the financing, you could have subtotal here. And certainly this needs to be picked up here only, right? It will save some additional time rather than constructing two tables, right? So this is how you need to construct. So key learning from this question, always read the ask carefully. So if the ask is to prepare the cash flow statement itself, then we would have, you know, use the cash flow statement format, right? Because the ask is to present the investing, financing, and operating activities. So we did this simple tabular format, right? So this is how we are going to present our answers. Any doubts, any questions on this?
No, sir, clear, sir.
Clear? Okay. Okay. Let's do this. Question number 7. What will be the classification of the following items in the statement of cash flows for both banks and financial institution and other entities? So these are the items given, and you need to tell the classification. Scenario 1, when the entity is the bank or financial institution. Scenario 2, when the entity is another entity. So what would be the efficient way to present our answer in the examination? We will present all these activities, right? And we will create two more columns. Scenario 1, bank. Scenario 2, other entity. And we will simply mark investing, financing, operating, investing, financing, operating against each of these, right? So that would be the efficient way in the columnar format. So let's come up with our thoughts. Interest received. So what I'm doing, I'm putting here bank. Your first answer would be bank and for other, right? Okay. So let's do interest received on loans and advances given.
Operating
Operating
finance,
activity.
Operating,
financing.
Investment activity.
Sorry, investment.
okay. Investment, Interest paid on deposits and other borrowings.
Operating and financing activity.
Same, Saminathan.
Yes, sir.
Interest and dividend received on investments in subsidiaries, associates, and other entities.
Investment activities, sir, for both.
Both?
Sir, first operating activity, second investment.
Okay. Dividend paid on preference and equity shares, including the tax on the dividends.
For both financing activities, sir.
Finance charges paid by lessee under the finance lease.
It's a finance activity.
Financing activity.
Both.
Yes, sir.
Yes, sir.
Payments towards reduction of outstanding finance lease liability.
It's
Financing activity.
again finance activity.
Interest paid to vendor for acquiring fixed assets under the deferred payment basis.
It's a
Financing
finance
activity, sir.
activity in both cases.
Principal sum payment under the deferred payment basis for acquisition of the fixed assets.
Investment activity.
Yes, sir. Investment activity.
Penal interest received from the customer for the late payments.
Operating activity.
Penal interest paid to suppliers for late payments.
Operating activity.
And interest paid on the delayed tax payments.
Operating activity.
No, sir.
For both.
No, it's interest paid on delayed tax payment. It's investment activity.
Okay. Interest received on the tax refunds.
Sir, interest paid on delayed tax payment is that financing activity. But the interest received on the tax refund is the investment activity.
I think
Okay.
last is also operating activity.
Okay. So we have noted down our responses. So let's see. Interest received on loans and advances given, operating and investing. Clear? For bank, it is the business only to give the loans and advances. So interest earning on that is the revenue income, right? Interest income is the revenue for them. Operating for others, it is always investing. Clear? Interest paid on deposits and other borrowings. Operating for banks, while for others, it is always financing because we are generating the funds for our business. But for banks, taking the deposits from the customer is a part and parcel of their business, right? Correct? Yes, no?
Yes, yes, sir.
It's
Interest and dividend received on the investment in the subsidiaries and associates and in other entities. Investing. Why? Because we are receiving the dividend from whom? Subsidiaries,
Subsidies.
associates, right? So these are our strategic long-term investments and not the revenue generating investments, right? So bank may have two types of investment. Investment number one, for example, loans given to earn the interest. And investment number two, for example, investment in subsidiary, which is a strategic investment. And now that subsidiary is declaring dividend. So that is a investment activity inflow, right? But if the dividend was received from some other entity, which is not the subsidiary JV or associate of the company, then it would have been the operating activity. Is that clear? for the banks.
Yes.
Okay, sir. For
Yes.
bank, actually, I had a slight confusion on this in dividend received. Now it is
So
clarified.
for
On
others, it is
for
always.
yes, sir. For others, I understood. For that banking institution, we studied in the initial slide that dividend received is the operating activity.
So that's what I'm telling now. So dividend received is to be understood on what investment. So if it is being received from my subsidiary, right, then it is coming from my strategic investment. But if it is not my subsidiary and I have only investment for the purpose of generating returns, then those returns is my revenue and hence operating activity. Clear?
Yes, sir. Thank you.
Dividend paid on the preference and the equity shares, including the tax. Financing only, because preference share capital is what? The capital or the financing which we have generated for conducting our business, right? So preference share capital, equity share capital, dividend payments, financing for both. Finance charges paid by the lessee under the finance lease for both financing. Payment towards reduction of the finance lease liability for both financing, and interest paid to vendor for acquiring PP&D under the deferred payment financing. I guess somewhere you must have said investing here, right? On the 7th. No, financing only. Both of you mentioned, right? Principal sum payment under the deferred payment basis for the acquisition of fixed assets. Investing only, because we are ultimately acquiring the fixed assets on credit first and later on discharging the liability, right? Penal interest received from the customers for the late payments, operating, because customers are not making the payments in time and hence we levied a penalty on them. So that penalty is being earned by virtue of making the sales to them earlier, right? So our relationship with our customer is what? Business relationship. And because of that relationship, if we are earning something over and above what we would have earned had the customers paid in time, right? Then that will also be by virtue of this operating relationship only and hence operating activity. Penal interest paid to supplier, again the operating, because if we are making any payments late, then it means there is an additional expense which we need to incur. So again operating. Interest paid on the delayed tax payments. So for banks, it is operating, and for others, it is financing. Why? Are you able to?
Yes, sir. The interest paid is a duty for operating activities. When there is a delay in tax payment, also when there is a TDS deducted is not paid on time, that also will happen on that operating activities for the bank. For financial things, why it is a delayed matter, which means the tax is due, which means the loan is received
Hmm,
from the income tax.
hmm.
So it is treated as a financing activity for the normal case.
Perfect. Perfect. So what is the notion here? The notion is, so banks or financial institution purpose is to, earn interest on their investments and to pay interest on their borrowings. Now, if a bank is supposed to pay income tax to income tax authority, say by 31st March, right? But they didn't pay that by 31st March and made a payment on 30th June, for example. Now they need to make additional payment of interest as well on those delayed tax payments. Yes or no? Yes. But for the bank or the financial institution, what they eventually have achieved by delaying the income tax payment, they have indirectly took a loan from the income tax authority itself. Yes or no? Are
Yes.
you able to understand
Yes.
what is the concept here? The concept is for bank, it is always a loan from the third party. whenever they are delaying any interest payments, right? So it is for them operating only, right? But for others, it is always financing. Why? Because their business is not to generate returns on the funds or pay interest on the funds. Their business is something else. And if they are borrowing money from somebody, then that is a financing activity for them. But for bank, it is not the financing activity, right? Interest received on the income tax refund, same logic. For the banks, it is the operating activity always, but for us or for others, it is investing activity because they have invested the funds with somebody to generate interest income. So for them, it is a interest income. For banks, it is a operating income. Clear?
Yes, sir. Clear, sir.
Okay.
So point number 6, other entity. For other entity, why not is operating activity?
Point number 6, this one.
Yes, sir.
So payment towards reduction of outstanding finance lease liability. What is the finance lease liability? Whenever we have taken any building or any other asset under the finance lease, yes or no?
Right of use, sir.
Yes, sir. But operating for business purpose, na?
For business
For running of
purpose.
the,
So, okay. So for business purpose, suppose Reliance Industries has taken a, a asset on lease, a building on lease from somebody for the finance lease, say for next 20 years, right? So this is a finance lease.
yes.
Yes. Now, there could be another arrangement which the company could enter into is rather than taking this building on finance lease, they could have purchased it. Yes.
Yes. Yes.
For purchasing that building, they could have obtained a loan from a bank.
Yes.
Yes. If they had purchased the building and they have obtained a loan from the bank to purchase the building, that loan would have been classified as financing activity.
Yes, sir.
Yes. So instead of making two contracts, one with the buyer, one with the seller of the building, and one with the bank, the two contracts we have combined into one financing agreement, one finance lease agreement. And what we have eventually done here, we took the building for next 20 years, right? On the finance lease. So whatever the we are paying is a discharge of the finance lease obligation. So finance lease obligation being discharged is a discharge of a liability from my balance sheet. And when I discharge the liability, long-term borrowing, long-term liability from my balance sheet, it is always a financing activity, right?
Yes, sir.
Clear?
Yes, sir. Clear.
Okay. Following from the following data, identify the nature. So we have to master these, activities so that if any of them come by any chance in any of the practical question, then we don't struggle in the examination hall. Cash paid to employees,
Operating activity.
cash paid for development of the property cost,
Investment activity.
borrowings repaid,
Financing.
Finance activity.
cash paid to suppliers,
Operating.
Operating.
loan given to director,
Investing.
bonus shares issued,
Nothing. No.
Non-cash.
Non-cash.
right? Not applicable for the cash flow statement because it is a non-cash item. Dividends paid,
Finance
It's a
activity.
financing activity.
cash received from trade receivables,
Operating.
Operating.
proceeds from the sale of the fixed assets,
Investment.
Investment.
depreciation on the fixed assets,
Non-cash.
Non-cash.
right? क्लियर, ये तो इजी ही था, इसमें तो कोई चैलेंज ही नहीं था। एडवांस रिसीव फ्रॉम कस्टमर्स,
Operating.
बताओ जी। एडवांस रिसीव फ्रॉम कस्टमर्स,
Um, it's a financing activity.
so you said
Operating
operating,
activity.
then you switch to financing, right? Others,
Operating activities.
operating. You want to move back to operating?
No, sir. No, no. I will clarify later.
Okay. So your answer is financing. Okay. एक बार बदल दिया, दोबारा नहीं बदलेंगे। परचेस्ड गुडविल,
It's an investment activity.
Investing.
इन्वेस्टमेंट।
Yes, sir.
गुडविल, गुडविल इन्वेस्टमेंट है।
Purchased one, sir.
Purchase, no.
ओके। पेमेंट ऑफ प्रोविजनरी नोट्स,
It's a financing activity.
Yes, sir. Financing.
ओके। फाइनेंसिंग। तो बाकी सब तो ठीक ठाक लग रहा है। आइटम नंबर 11 को देख लेते हैं ना। एडवांस रिसीव्ड फ्रॉम कस्टमर ऑपरेटिंग,
Okay, sir. Thank you.
अब क्यों है ऑपरेटिंग?
So why I changed the decision to investment activity since the money is received without any transaction. So
नो 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 नो
ultimately,
नो।
so
So,
now I
so
understood.
okay,
Ultimately, the
understood,
purpose of
understood your point.
yes,
So we have to strictly go by the color of the transaction. What is the color here? Customer is coming to us saying,
operation.
boss, I need the raw material. I said, boss, raw material is in high demand. I cannot make the delivery upfront. You need to give me advance and come after 30 days to collect. Right? So he gave me the advance to collect the raw material delivery after 30 days. Right? So this advance is received to me against the order which we has placed with me, right, for purchase of goods from me. So this advance will ultimately be adjusted against the sales invoice. Yes or no?
Yes, sir. Perfect.
So this is a operating activity for me. Clear?
Okay, sir.
Sure. Let's do the full-fledged one more question before we wind up for today. And I expect you to do this question 100% correct. Okay. So that we can end the session on a positive note, right? One of the subsidiaries of the Buildwell Limited submitted to the Central Finance its summarized statement of profit and loss account and the balance sheet, summarized statement of P&L for the period ended 31st March 2003. Net sales, cost of sales, depreciations, salaries and wages, operating expense, provision for taxation. Then net profit, non-recurring income, profit on sale of equipment, retained earnings, profit brought forward, dividends, and finally the profit closing balance, right, for the year 31st March 2003. Now, this is the balance sheet given, right? So PP&D, land and building, right? Current assets, cash, inventory, trade receivable advances, liabilities, share capital, surplus in the profit and loss, trade payables, outstanding expenses, income taxes payable, and the accumulated buildings and equipments. The original cost of the equipment sold during the year was 7,20,000. Prepare the statement of cash flow for 2003. See, the question is so simple. Only one adjustment, right? So lucky. Only one adjustment given as additional information, and rest is the balance sheet and the P&L only which we have, right? So you can start taking the screenshots, right, for this. So just take the screenshot of this P&L page. Done. Then you can take the screenshot of this remaining P&L page, and then I will showcase the balance sheet on the screen itself. Adjustments anyway, we don't have much, right? Done. Now this is the balance sheet. So I give you again the 10 minutes to prepare the cash flow statement, and then we will discuss the solution item by item. Your time starts now. I hope you are trying. Let me know if I need to scroll up or scroll down. I will do that. Trying or not trying? Energy is drained, huh?
No, sir, trying, sir.
Trying. Okay. Any scroll up, scroll down required? Any luck with the cash flow from operating activities? Need one or two more minutes? Or stuck somewhere? Yes, no.
So just can you scroll up once?
Sure, sure.
No, sir, cash balance, balance sheet. Sir, I need balance sheet part, sir. Cash balance of.
Sorry. Cash balance, you said.
Yes, sir.
Done? Ready for discussion? What happened? Stuck somewhere?
Yes, sir.
Ready? Okay. So Net profit before taxes and extraordinary items 720 plus 880, 16 lakh. Is this correct for you? Have you picked it up right?
Yes, sir.
Okay. Then depreciation added 6 lakhs.
Yes, sir.
Operating profit before working capital changes. I hope at least until here everybody is correct, right?
Yes, sir.
Now, for increase in inventories and decrease in trade receivables, we need to see our balance sheet, right? So here is the inventory and trade receivable items coming, right? And this is the previous year, and this is the current year, right? Notice this,
Yes, sir.
right? And I said before that in the examination, we need to be very careful about these years in the balance sheet, right? Because otherwise, all the adjustments will go on toss. So now I hope you have calculated these working capital movements correctly, right? For these years. So you must have placed it here, right? Now let's go to the notes first of all. So all these ledgers we need to construct in this question so that we arrive at the right amount of the cash movement for these items. So first of all, we will construct the ledger of the building and equipment account, right? Then we will construct the ledger of building and equipment accumulated depreciation account. And then we will compute the sale price of the equipment, right? Now in the question, it is mentioned that the equipment is sold costing rupees 7,20,000, right? So this is the only information given in question, correct? Yes or no?
Yes, sir.
Right? Now rest all information we need to find out. So first of all, we'll start with the balance. So balance given in the balance sheet is this much, right? And the closing balance is also given in the balance sheet, right? And then the sale, which is happened, costing rupees 7,20,000. So that is the cost. So we are constructing the ledger of the gross block here, right? So this gross block contains the cost, right? So we will arrive at the balancing figure of 28 lakh 80,000, which is eventually the purchase during the year, right? 28 lakh 80,000. Now, depreciation ledger. So balance brought forward is here and balance closing balance is here, right? And what is the sale which we have made during the year? That information is available to us. So 7,20,000 is the cost price, and this item's accumulated depreciation we will pick up 480, net cost 240, profit on sale 120, and the sale proceeds is 360. So all these we need to calculate ourselves with the information available in the balance sheet and the P&L extracts, right? So if we go back to our balance sheet and the P&L extracts, so what information we have here? So here, these are the opening and closing balances of the building, right? Then here the accumulated opening and balances of the depreciation are given, right? And then this 7,20,000 is the cost of the equipment sold during the year given here as a notes. And lastly, in the P&L, the depreciation figure is also given, right? This much. Correct? And then non-recurring profit sale of equipment profit is given 1,20,000, right? How much profit we have earned. So this is the profit which we have earned on this sale, and the cost is given in the adjustment. So can we construct at what value the sales have been made, right? By doing all these ledger constructions, balance brought forward, balance carried forward, right? And the accumulated depreciation and the balancing figure. And doing so, we will be able to arrive at the sale proceeds from the sale of the assets, 3,60,000, right? And what is the purchase? Purchase we have arrived above here, 28,80,000, right? So this is the purchase. Now go back to our the cash flow statement. Here we need to record this under the investing. So 28,80,000 and the 3,60,000. So this is for the sale of the equipment and this is for the purchase of other building and equipment which is hidden, which we have identified ourselves by constructing these ledgers. Correct? Did you find it or you were stuck?
Yes, sir. I got stuck in that sale of equipment, that 3 lakhs.
Sale of equipment. So, but
Yes.
this 2880 you calculated.
Yes, sir.
Okay, so you stuck here, right? So this
Yes.
is now understood.
Yes, sir. Understood.
Okay. Now the purchase of land, this 480, how it is coming from?
Balancing figure, sir. Land ledger account.
Land balancing figure in the balance sheet itself, right?
Yes, sir.
So this is coming from the balance sheet. So now all these three taken together, cash outflow from investing activity. So we will say it net cash used for investing activity, correct? And then form for financing, issue of share capital from the balance sheet, dividends paid from the P&L. So cash from financing activities. Total up all activities taken together, opening cash and cash equivalents and the closing cash and cash equivalents, right? This will be reconciling. Now, one item which we didn't discuss is the income taxes paid calculation, right? This item. How this is calculated? Let's go to the working note number 4. So we are given the balances of liabilities, right? So balance brought forward given in the balance sheet, balance carried forward given in the balance sheet, provision during the year recorded is also given in the P&L 880, right? So how much we have discharged is the balancing figure out of these three, correct?
Yes, sir.
So this 868 we will use in our cash flow statement for income tax discharge, right? And rest all adjustments are anyway coming from the balance sheet. So this would be the net cash flow from operations. So basically, anyway, cash flow statement you will be able to prepare, right? The only point is how we come to know which all working notes we need to calculate or which all ledgers we need to construct, right? So in the previous cash flow statement, we did not construct the ledger for the accumulated depreciation, right? But in this question, we are doing, right? In the previous question, we did not do the sale price calculation of the equipment, but in this question, we have done, right? Now, how do we come to know? How do we identify what all we need to do before finalizing the cash flow statement? So that depends on the information given in the question. So because in this question, the additional information which was given is this line only. What this line is, the original cost of the equipment sold during the year 720. So 720 is not the selling price, right? It is the cost of that equipment which has been sold. Now, by having this figure, neither we know the selling price nor we know the WDV of this equipment, right? And gain gain or loss will be selling price minus the WDV, yes or no? So neither we know the selling price nor we know the WDV. But what we know the cost of the equipment which has been sold. So first of all, we need to arrive at the WDV. So cost minus depreciation we need to do, right? Yes or no?
Yes, sir.
And then because we know the gain, so gain plus WDV will give us the sell value. So this is how we will be arriving at the sale value. So this is all what we have presented in this working notes. So original cost minus depreciation, net cost, and profit given in the question, profit and loss. So sale proceeds is this much. So 3,60,000 is the sale proceeds, 4,80,000 is the WDV. Sorry, 280 is the WDV. Right? So this is how we need to find the missing pieces. So basically, this is nothing. This is the test of our ability to find the missing pieces. Yes or no? Correct? Did you like this question? It was looking very simple, right? But it actually resulted in a lot of missing pieces finding, correct? When there were less information in the additional information, it doesn't mean that the question is, straightforward. It might be more tricky as compared to the regular one where many adjustments are already given in the question, right? Okay, anything you want to ask or discuss? We are on top of time. Yes, no. Silence means no, right? So with that note, I wish you all
Yes,
the
sir.
very best. And I wind the session up now for today. And just one advice, do practice, more practice, and more practice. Thank you.
Thank you, sir.
Session is over, Ashokji. Thank you.